Hey everyone, it's Ian for Bold Profits. Welcome to your weekly Friday video. There's more and more recession headlines, of course, coming out every week now that we get closer to the new year. There's going to be more and more coming out. The last quarter of the year is usually the most busy time for this. So this is completely expected. Today I want to talk about the most recent threat, I guess you could call it, but the most recent thing that's making headlines. And first, I want to point out that there was this survey that came out this past week, I think it was yesterday or the day before, that said that 53% of U.S. CFOs of publicly traded companies believe that there's going to be a recession by the 2020 election. This is the highest level of people or CFOs that believe this in the past 3 years. And that's kind of funny because 3 years ago, or in the past 3 years since the last, I guess, pessimistic outlook, I guess, whatever you'd call it, in 2016, everybody was really bearish and really pessimistic, and there were all kinds of calls for a recession in 2017. And ironically, since then, we've had the highest GDP growth since the financial crash. So even in the initial recovery of 2009, 2010, and 2011, we've outpaced that actually in the past 3 years of GDP growth. So since then, it's only gotten better, and we expect that to continue to happen. And people base their predictions off of these kind of arbitrary numbers a lot of times. And this is something that Paul and I have really noticed, especially recently, when people talk about things like, now that the bull market's 10 years old, it's due for a pullback. Like 10 years actually means something. The inverted yield curve, now that the 10-year interest rate is below the 2-year interest rate, that means something. It didn't mean anything when it was 0.1% above it, but now that it went below it, there's going to be a recession for sure. Like, it's a sure thing. And the most recent one that we've been seeing has to do with oil, because of course there was a big attack on the Saudi Arabia oil producing facility last weekend, and as a result, oil prices were up 15% Monday. And of course, headlines were pouring out saying that this rise in oil prices is going to cause a recession. And the magic number, of course, where you have a crystal ball and you know a recession is going to come, is if oil goes up 100%. And of course, that also has to be in a calendar year. It can't just be 12 months. It has to be a calendar year. So if oil goes up 100%, that automatically means there's a recession. I saw this number cited in at least 5 articles. And it's, again, this arbitrary number requires no brain power and no further thinking or looking at anything that has to do with anything. It's just this one number that's apparently supposed to signal a recession. So that's the most recent kind of driver of these recession predictions, is that oil strike. And there's been a number of other things. One of them actually that I actually found on a legitimate website, I think it was Business Insider or Forbes or one of those, but they actually cited the number of Google searches of recession as an indicator that there's going to be a recession. So this is where we are. And there's another there's this index, I think it's in Europe, and it tracks the number of newspaper headlines and media headlines that have recession in them or some buzzword that's negative, that's about the economy. And it tracks these. And the higher it is, I guess they are saying the more likely it is that there's going to be a recession. We've gone from focusing on things like production and GDP growth to headlines. And these are the headlines, remember, of the companies that are really struggling to stay in business, especially newspapers. Nobody buys newspapers anymore. I've never read a newspaper. I'm 27 years old, and this has been on the decline probably since I was in middle school. Ever since the internet came out, newspapers have been severely hurting for business. Cable news is the same kind of way. So CNN, things like that, Fox, all these news stations, MSNBC, they've all seen big drops in their viewership. And so they have to keep people's attention. The news channels, the newspapers, they have to keep people's attention by putting these scare tactics in there in their headlines. And that's why there's so many headlines about recessions and about like economic crashes or whatever. It's all due to fear sells. That's the main point here. So arbitrary numbers, and causing fear in headlines. Those are the two biggest things that are really driving the fear in the market right now. The oil thing is not an issue. Obviously, we saw that in our market on Monday. It barely went down. I think the S&P was down 0.2%. And markets all over the world were hardly affected. And that is because the U.S. is now the number one producer of oil for the first time ever. We produce almost as much as the number 2 and 3 countries, Saudi Arabia and Russia combined. And we have the technology now to basically turn on the production of oil at any speed we want, at any time we want. So if there is a shortage, we could just produce more. And that's where we're at. That's different than the past. So this is where the critical thinking comes in that people don't want to do. The price of oil going up 100% in the old days really meant something. Now, if the price of oil goes up 100% in a year, which is really unlikely anyway, but we have the technology that we didn't have before to produce more, cut the global shortage, and just flood the market with more oil if need be. It doesn't mean there's going to be a recession. Obviously, the markets know that, but the headlines are still saying things like if the price of oil doubles in a calendar year. Remember that critical component of this. In a calendar year, there will be a recession. So it's all just kind of gotten ridiculous at this point. You could also take the cynical view of this. Saudi Aramco, the $1 trillion, or more than $1 trillion, I think they're valued at now. The company in Saudi Arabia, the biggest oil producing company in the world, has been trying to go public for, I think, like 2 years now, at least. And so they would want a positive market environment to go public, which means higher oil prices. And they would, because higher oil prices mean that the oil companies are valued at a higher price, obviously. So if oil is $70, ExxonMobil is going to be worth more as a company than if oil is worth $40. So that is kind of, like I said, the cynical view to take, the conspiracy view, whatever you want to call it. But it would raise the valuation of Saudi Aramco. They've been trying to go public for a long time. Of course, they want the highest possible valuation. The investment bankers behind the deal want the highest possible valuation. And oil just happened to bounce 15% on Monday. So you can take that however you want. But overall, we don't see this as a concern. Obviously, it's not good for production in Saudi Arabia, but global production is really not going to be affected for any length of time. And we saw that in the market's reaction this week. So for my millennial topic this week, I want to talk about how we're affecting the home buying industry. And I want to start out by prefacing this with some data that came out Monday. The number of building permits that were created in August were the highest since May 2007. I believe it was about 1.42 million new building permits in just a month, which is, like I said, 12-year high on that. The new homes that are starting to be built, called new housing starts, those were also a 12-year high, the highest amount produced in a month since June 2007, just in August. So August was a huge month for the housing industry, building permits and housing starts, of course, two major kind of leading indicators suggesting that the home buying market, the real estate industry, is in full force growth mode. And that's really being driven by millennials. And I've talked before about how much millennials are obsessed with saving. They're obsessed with being able to retire on time. And they're obsessed with stashing that money away in a 401k or their own investment account or anything like that, even savings accounts. We want to save money. We want to be successful, and we want to be prepared for retirement because we saw how bad things could get as soon as we were in college or graduating college, looking for a job. Unemployment spiked, the stock market crashed, the economy overall crashed. We were in the heart of that. We were, like I said, getting into the jobs market. We really felt the full extent of that. We saw our parents really be affected in how they could retire. A lot of people's retirement plans got pushed back because of this. So we want to be prepared for anything that could happen in the future, whether that be 5, 10, even 15 years down the road. We want to be safe. So as a result, and of course, there's been very, very high student debt levels recently. So as a result, with people wanting to save, be prepared, and have these high loans, it's caused people to move out of home later or buy a home later. So a lot of the past few years, we've seen millennials start to move out of homes or stop renting and start buying. I did that too. After the first couple years after college, I lived back at home with my parents, and then I went and lived in an apartment for about a year. And that's relatively short. A lot of millennials are doing that for more than 3 years. They're renting, finding a cheap apartment somewhere, and they're stashing money away to buy a house. And of course, in the meantime, they've been paying student loans. So the home buying process just gets pushed back farther and farther. And now we're finally starting to see millennials buy homes. And this also means that we don't need the same kind of starter homes that people needed before. Obviously, when you're 30 and buying a home for the first time, you've got more money saved, and you're also making more money per year than people used to when they were 20 or 22 and buying a new home for the first time. So starter homes are getting better. That's what's driving all these new home sales is we want nicer homes. We can afford nicer homes than previous generations. Of course, a lot of homes on the market right now are outdated. So we want new things, and we can afford them because millennials right now are making a lot of money. They're saving at a fast rate, and they can afford these new homes. And that's the target market for new home sales right now, of course, is millennials. About 60% or more of every other older generation, so Gen X, the silent generation, baby boomers, all of these generations are above 60% home ownership rate. So more than 60% of each one currently owns a house. Millennials are all the way down at 37%, and that's after a 5% increase in the past 3 years. So 5%, of course, may not sound like a lot, but that accounts for about 4 million millennials. So just in the past 3 years alone, 4 million millennials have bought a new house or bought a house for the first time. And it's really been this huge wave. So there was this big report out by Zillow that I'm going to cite a couple times, but one of the things they said is that 86% of younger millennials have bought a house in the past couple of years, and 52% of older millennials have bought a house. This was since 2015, I believe, were first-time home buyers. So we're seeing this grow extremely fast. Almost all the millennials right now that buy a house are buying the house for the first time. And like I said, we're still only at 37%. So this is going to last a long time. We've got more people than any other generation in this market. There's so much room to grow. So the real estate market is right now poised to just grow extremely fast over really the next generation, because Gen Z is not far behind, and they're expected to outnumber millennials within just a couple of years. So this is a trend that we're going to see, a generational trend that could last for 30, even 40 years as millennials and Gen Zers start to enter the home buying market. Another thing that this report said was that the median new home buyer, or the median age of somebody buying a house right now is 36 years old. That's extremely young. So even if you look at just every home buyer, not even just first time ones, but all home buyers, it's a really young crowd. It's a young group of people, and it's a lot of new homes that are being built just within the past couple of years. Because like I said, starter homes are getting nicer and nicer because we're moving out later. We have more money saved. We're making more money. So it's just a really good all-around scenario right now that's playing out for the home building industry. Of course, construction, real estate, all these things are linked. And it's something that's going to continue for a long time. And something that's also related to that is that the median first-time home buyer is only 34 years old. So there's not even a big difference between the median age of all home buyers, the median age of first-time home buyers, which shows that this younger crowd that's driving the home buying, or the demand for homes, are mostly first-time buyers. So 34 years old is really young too. And there's about 45 million Americans that are under 35 years old. And the rate of home ownership for 35 years old Americans and younger than that was 43% back in 2004, back before the real estate crash and all of that. And now, like I said, it's dipped a lot. So it could go back up to 43% very fast. And 45 million Americans between 24 and 33 years old. That's a big crowd to really push this growth up even more. So like I said, this is a generational boom of the home building market, of the real estate industry. It's a driver of the economy. It's one of the main reasons that we don't see a recession happening anytime soon, not just because we're buying homes, but more fundamentally because we can buy homes, because we're in a strong economy. We're making money much faster than the rate of inflation. And we're saving more money. Millennials have saved, or on average, have saved like half of what Gen Xers have saved. There's a 20-year gap. In 20 years, we're going to be way ahead of any other generation before us in terms of saving for retirement. And that's going to drive new home growth too, because we're going to be able to afford even nicer houses going forward. Gen Zers are going to be moving in, buying homes probably within the next 5 or 10 years. And there's just going to be a ripple effect that continues throughout millennials and Gen Z demand for homes. And also just the way that the economy is boosting our savings, just boosting our spending. As I've mentioned before, the consumer economy, or the consumer spending, drives about 2/3 of our economic growth. So as we make more, we're not just buying new houses, but the fact that we can buy new houses also suggests that we have money to spend on other things too. And we've seen the highest consumer sentiment since the 90s recently. So things are overall looking very good. I kind of got off a little bit there from the home buying industry, but I want to recommend a way that you can invest in this. So there is an ETF. It's a home building ETF. It has all of these great companies in it, dozens of home building companies, construction companies, and it's a really, really good time to buy in. The ticker symbol is ITB. So I just want to give that as the takeaway this week for this trend that's just going to go on for 10, 20, even 30 years out, maybe even more than that. This is going to be a generational thing that we're going to continue to see the home ownership rate for millennials increase, for Gen Zers really start to go up a lot soon as well. And that is what I wanted to talk about this week. This is Ian Dyer for Bold Profits. Happy Friday, everybody, and have a great weekend.